So, first message of February, and an interesting couple of days to watch what's happening out there. And it really has to do with hard assets. You know me, hard assets. Does it mean I'm not invested in shit that's not hard asset? Yeah, I am. I do have investments out there, not hard assets. And what they're doing? They're doing jack shit right now. They're actually kind of pissing me off, involving putting money into somebody else's idea, right? Which is a great damned idea. But then it's not so much their idea, it's their ability to operate their idea. That's where the problem lies. You would think that with what I preach, that maybe I wouldn't have stepped into those worlds, but I still stepped into them because I figured out, I will risk some things. I'll long shot some things. I'll see what ends up happening. This could be really, really monster. And, some of it helps, right? Because it gives me access to certain things. But for the most part, they're all losers. There's not a single one that's not working. In fact, one of the things I've also noticed, there's funds out there. People put together these big funds. You can collaborate your capital. They'll invest it in different things. They'll make so much money and everybody gets a return because you get an entry that you'd never get otherwise. Sometimes it takes billions of dollars or millions, let's say tens of millions of dollars to operate at a certain level when it comes to investment. But you can't do that personally. But you can collaborate with a manager of these funds to invest in big things, right? And by doing that, you get a piece of that return. You get to now have a seat at the table. Problem of it is how well are they investing it? We've seen a lot of those go to shit. And it's not because these people are bad people. It's because they really probably got in way over their skis. Now, what do we look at? I'm talking about hard assets here. Let's look at some hard assets right now. Here's a hard asset that I think is very, very interesting to watch. What has happened, how it's just grown and grown and grown. It's spiked up and then massive hammer down. We're talking about gold. We're talking about gold going as high as $5,300 an ounce and all the way down to $4,600, almost $1,000 swing in practically a day. We also saw the same thing in silver. Silver saw a massive, massive move. Same thing. Look at how big that one was. Went as high as $114. Is the highest it shows on this chart. I thought I saw it higher than that on some spot prices and went all the way down to 77. It matched up with where it was back several months ago. I need to get rid of this bar here so you guys can see this. So, back down to where it was back in January 8th. Not that long ago, right? But look at all that movement. Why did it do that? Why would something like that happen? Well, it's because what's happening in these markets, it's not about the actual solid asset itself. It's not the physical asset. What you have is the different entities, large entities hold this, but they don't hold all of it, right? In London, the biggest bullion hub on earth, the metal doesn't actually move around. They move claims at that point. The LBMA owns. Guide admits that they over 90% of the wholesale precious metals trades are clear as unallocated. That means it's not your bar. It's a contractual claim that somebody else has on it, but they're going to move the contractual claim around. So if you're looking at this from the perspective of you don't have forklifts moving bars around, you have paper claims being created on the internet and moving things around on paper, more or less, or actually electronically. So when you're buying gold in the paper system, you're not buying a bar, you're buying exposure to a counterparty ultimately. And that means that's the main point. When a system is built on claims, it'll always defend itself with price gains. So what you have here is the physical holding of it went way up, but they don't have the ability to meet those claim demands as with what they have in paper allocation. So what do? Manipulate the price and push it down so they can meet some of these demands without crushing them because we're in a fractional market. So if you shift it to buying houses, so I'm big into homes, right? You leverage a home, you take their debt, but it's fixed, structured, and predictable. That's what we always claim here. And you convert it to something that produces real value in the real world, which is shelter, rent, cash flow, and equity. And you control it. Stocks can be halted. Funds can create redemptions. Accounts can get reviewed, but deed is deed, tenant is tenant, and property is property. So that right there, I want to keep pushing that out there to everybody. Investing in something that somebody else's paper holding it's paper. It's flexible. They can create it, they can net it, they can hide it, they can strain it, and do whatever they want with it. You want to hold assets, but assets are solid. They're honest, right? Paper is somebody else's promise. Asset is your position. So we want to make sure that we're in a position, even if you're involved in some sort of form of paper leverage, you want to hold the asset itself. That's why precious metals, big thing to be holding right now. Not freaking out because they're shaking out like this. If you look across the globe, they're actually worth a lot more externally because they don't have these big banks I mean, look at what Goldman Sachs is in the middle of right now. There's a big freaking mess there. There's a whole bunch of other ones. Now, these are all speculative. Look them up. I don't know. I'm not in these boardrooms. All I hear is what people are talking about. That most of these banking entities that trade in precious metals, they trade in actual paper on it, not in the metal themselves. They're overextended, and they've got to get this down so they can meet that demand. And they probably met it all over the last 24 hours, or a lot of it. So let's look at what's going on in the bonds, because that's what everybody's here for. You're here to look at what's happening in interest rates. Like what we've been seeing over and over and over again, they get to that point and they pull back. They pulled back hard yesterday. And now they're down in here playing this particular space. And the reason why they pull back the claims are, is because of the manufacturing index, that was very, very high. What happened there? We came out with numbers that were beyond what was anticipated. Today, we got the jobs openings. It's delayed. We don't have that coming out yet. So that's what I anticipate. There's going to be, and it's actually good when some of this news doesn't come out, in my opinion, because look, we had this really smooth movement when they had the government shut down and we had nothing coming out. And then you have the times before that, as you can see exactly how messy that was. It was all over the place, monster volatility when you start getting conflicting data that comes out, because anymore, the data is not real data is political. So what we have here is we're still below this. We're still in great rates. I'm not going to sit here and speculate on what's driving up the candlestick today, because ultimately it's below where I said would be our peak price. And the only thing that pushed above that peak price was the talk of additional quantitative easing by having the GSEs put money into the mortgage-backed securities, which has yet to happen. They're still just speculating. I'm still talking about how to distribute that. But see what that news does. See what happens when they're talking about quantitative easing. Quantitative easing is the only way we're going to get these rates lower, because there's not enough money going into this to drive the rates lower than that. You can't just have the Fed say we want lower rates. You can't have the president say we want lower rates. You have to have money going into this specific security, the mortgage-backed security, not the freaking 10-year, not the 10-year. In fact, let's look at this, guys. Look at what we have here. I'm going to zoom in on this again. If you see here how these have gone up, peaked off of this, and we had a lot of red going on here. Ultimately, you got to know where the money's at. You got to know where it's going. You got to know where it's being driven. And right now, not enough is being driven to drop the rates down. Pick up the housing that makes sense. If you don't know how to make sense of it, book an appointment. info@aaronchapman.com. Let's get a conversation happening around that. Let's help you understand what makes sense and what does not. Now, you're the CEO of your real estate investment business. You got to make decisions for yourself. I'm just going to give you things to think about so you can make that decision. Appreciate you guys, and we'll talk to you guys soon.